Welcome to the December monthly market report. We're going to talk about a lot of topics today, but just wanted to take a moment and thank you for following the monthly market report this year and investing time and energy into being the educator on the most important topics in real estate. My name is David Childers. I'll be walking you through, along with Kate Resbeck, several topics today, including interest rates. Certainly they define this year, and we're going to talk about that and what's going on. Second, we'll talk about some headlines that are out in the world of real estate. And third, Kate's going to wrap us up talking about what's to come going into next year. And you're going to want to grab those slides because I think they're going to be really, really important as we go through the next few weeks and we're around others at holiday parties and things like that. Maybe have those on your phone, have them ready as people ask about the real estate market. So let's jump right in. This first topic that we have, what's happening with mortgage rates? You know, this picture here that our team put together, I think is really, really appropriate. It's a roller coaster. You can tell these folks are on a loop there, but what I can't tell is, are they going forward? Are they coming back? I can certainly tell they're upside down, and that maybe feels like what we've seen this year in mortgage rates. You know, a couple of quick facts. We've never been in a year where the interest rate, the average 30-year fixed, has doubled in 1 year, and it's been the fastest rise in mortgage rates since they started tracking them over 50 years ago. And so to say it's an anomaly year in a lot of ways is certainly the truth. But I want to kind of break down where rates are at right now and a couple of very interesting things that I think sort of tip the hat to where they're going into next year. Now, no doubt this year has been defined by rising interest rates, but that's, you know, the moral of the story, or the story there, is all about inflation. And going forward, what's really going to be the determiner of the market is the Fed's ability to control inflation. But let's kind of go on this journey and let's break down where rates are at right now and where experts are sort of pointing to them going into the next year. So first quote here from Lawrence Yun came out: a return to a normal spread between the government borrowing rate and the home purchase borrowing rate will bring the 30-year mortgage rate down to around 6%. So as I'm recording this, the average 30-year fixed right at about 6.5%. We've seen a little bit of relief over the last few weeks, but what Lawrence is referencing here is the 10-year Treasury, calls it the government borrowing rate, and then the 30-year fixed, the relationship between the two and the spread that we see. And, you know, if you follow the monthly market report, if I were to give you maybe an image that best describes what he's saying right here, it's this image. If you remember that, for almost 50 years, the 30-year fixed mortgage rate has moved in unison with the 10-year Treasury yield. So if you want to know where mortgage rates are heading, watch the 10-year Treasury yield. And that spread between them, you see in the middle of the screen here, the average spread has been about 1.7% or 170 basis points. So literally, if you take the 10-year Treasury, you add 1.7% to it, you would then get the 30-year mortgage rate in the range there. It's been on average a spread of 1.7%. You know, every time we've talked about mortgage rates this year, we've used that graphic that shows them just shooting up as the year has gone by. And I mentioned a couple of very interesting facts about this year's mortgage rate that we haven't seen before. It's been a market that experts and forecasters have never seen before in a market that's doubled in the fastest move in the last 50 years. But if you look at the 10-year Treasury, this is a look at the 10-year Treasury as of December 1st. Okay, it goes all the way back to the end of last year through December 1st. And what do we see? Just that rise up. The 10-year Treasury has been rising, you know, kind of up, down, but the trend has definitely been up. Now, let's talk just a minute about that quote that Lawrence Yun mentioned. He said, a return to a normal spread. Now, that's the spread between the 10-year Treasury and the 30-year fixed rate. And I want to kind of break that down for you to maybe show you what that means. And I'll use this graphic right here and sort of pose the question, why are mortgage rates not at 5.5%? And if we start at this box on the left, if you were to go back to the 2000, look all the way to 2021, you know, and look at the average 10-year Treasury, the average spread 1.7%. You see the 10-year Treasury 3.49% in that blue box. 1.79 in the orange box gives you a mortgage rate of 5.28%. That would be the average between 2000 and 2021. Well, where are we at today? I mentioned before the mortgage rate 6.49% on the average 30-year fixed. Well, today, as this is being recorded, or as of December 1st, the 10-year Treasury yield at 3.5%, the spread 2.99, giving us that 6.49. Now, today, if the spread were normal and we were in a range, let's say 3.7%, and then on this third box, and we had the 1.79 spread in the Treasury yield like we've had historically, we'd be at about 5.5% in the average 30-year fixed. So why is that spread much higher right now than what it's been historically? The quick answer for that, and I wouldn't advise anybody to try to get into secondary market analysis with clients, but it's a nod to a couple of things. One, market volatility, no doubt, is driving rates higher. And second, the investors that determine these rates know that everybody that's buying right now will refinance these mortgages. And so they're charging a premium for them. I think if I'm looking at this and I'm trying to give good advice, we wrote a blog on this that said mortgage rates will come down. It's just a matter of time. As we go into next year and we get inflation under control, the Fed continues to work. And I don't think we're out of the woods right now as we record this by any stretch of the imagination. But what are experts saying about rates as we go into next year? Let me give you a couple of perspectives on that. Ali Wolf says this: the housing market is expected to face continued uncertainty heading into 2023 as consumers, financial markets, and policymakers work through their respective challenges in today's economy. No doubt we're in an uncertain market, a market there's a lot of volatility and a lot of questions on the economy, on geopolitical events, war in Ukraine, all of those things causing uncertainty. As we move into next year, what we want to see is some of that get eliminated, inflation get under control, and there's still more work to get there. If we take Barry Habib's perspective from MBS Highway, because we see a slowdown and we see the inflation comparisons start to become more and more favorable, you'll start to see that inflation number move lower, lower, lower. As a result, mortgage rates should move similarly on a downward trajectory, probably giving us around 5% or below 5% within the next 6 months. Now, we'll see if Barry's right about that, but no doubt, as the market becomes more certain going into next year, we should expect interest rates to go down. Now, I don't think we're going to see anything in the 3s or 4s, probably likely maybe in the high 5s, low 6s, but no doubt as we see more of that, we should expect for interest rates to get a little bit of relief. So, I think the amazing thing about that is if you turn on the news or you watch the news, you certainly don't see that in the news. Most of the housing market information is doom and gloom. And here would be my message on that. It would be this: don't trust headlines without the proper context. There are so many headlines flying around here and there saying things, giving you information, certainly giving clients information that does not always best represent the truth. And I'll give you an example of this. Diana Olnick published this as a tweet. Homeowners have lost $1.5 trillion in equity since May as home prices drop. This is coming from a Black Knight study. So factually accurate headline there, but what we want to do is we want to be able to put this into perspective. If somebody sees that and they think, gosh, the housing market sounds like it's about to tank, well, that drop in equity put in perspective looks just like this. There's been a surge in tappable equity in this country. Tappable equity is until you get to 80% LTV. The last 20% doesn't even count in this scenario. And what do you see? This run up from 2020 to 2021 and even into 2022. And it just gives you a perspective, even visually right here. You can see nowhere near where we were back in 2008 or the dip down during that time. So it's always important to take a headline like that, put it in perspective, be the educator for those that we serve. First American said this: homeowners have very high levels of tappable home equity today, providing a cushion to withstand potential price declines, but also preventing housing distress from turning into a foreclosure. The result will likely be more of a foreclosure trickle than a tsunami. And, thankfully, we're seeing that in a lot of other places. Experts say, the level of equity that homeowners have today is providing them with options if they were to have to do something, if they were to have to sell, limiting the number of people that go into foreclosure. And I'm going to talk about foreclosures in just a minute, because I think this idea of debt is a topic that many of us, are wondering about going into next year with inflation bearing down on everyone. How is that going to turn out? And, if you look at the headlines, I'll give you an example of a CNBC article here. Household debt soars at the fastest pace in 15 years as credit card usage surge, the Fed report said. This is an article from the New York Fed. Quick run up in household debt, credit card usage. And, again, if you think about household debt, this is talking about credit cards, but then maybe that leads to delinquencies in a mortgage. And we'll talk about that in just a second. But if we go back and, again, we put this into perspective, credit card balances are near their 2019 levels. So if you think about where we were in 2019, go into 2020 in the pandemic, now we're coming out of that. What do we know happened? It's very explainable. During the pandemic, stimulus money, loans that were given to people. We know that savings rates jumped up during the pandemic. People weren't using their credit cards. Now that we've worked through that, people are again borrowing and using credit cards. Now, we want to stay on top of this. We want to continue to monitor this, but it's not exactly accurate when you look at that and think, okay, where are we with credit card debt? Liberty Street Economics, which is the blog of the New York Fed, said this: though delinquency rates are rising, they remain low by historical standards, and suggest consumers are managing their finances through this period of increasing prices. So as inflation is affecting everyone, consumers are managing through that versus being taken down by it. That directly leads to the mortgage conversation, because if you can't pay your bills, you have to use your credit card. Okay, can you pay your rent? Can you pay your mortgage? And we want to start to look at that too, or be educated on that. And what we always like to use is the household debt service ratio for mortgages as a percent of disposable income. And if you look, this is published by the Fed. If you look at this, where we stand today, 3.9%, considerably low when we've been in the 80s, the 90s, and the 2000s. And I bring this to you for a couple of reasons. If we're not educated on these things, then the headlines, the conversations, what people say, sway us from one side to the other. And having the facts, having all the information, and being armed with it, I believe is critical. It's no longer something that's nice to have, it's a must-have in this market. Because these conversations are going to continue through the winter, through, depending on where you're at, the long, cold winter. And I think there's more that we need to get through in this market. I think interest rates are still going to be volatile, even though we've seen some relief here. But, all of this is going to kind of pretend to, are we going to make it? Is housing going to crash? And certainly, articles and folks on YouTube and other places saying that. I want to give you a little bit of perspective right now on that, and start with delinquencies, because that's obviously the leading indicator of any foreclosure, is something would go delinquent. MBA, Marina Walsh, industry analysis, for the second quarter in a row, the mortgage delinquency rate fell to its lowest level since the MBA survey began in 1979. Declined to 3.45%. Foreclosure starts and loans in process of foreclosure also dropped in the third quarter, the levels further below their historical averages. So here's what I'm here to say. This is the reality in delinquencies. They're lower than what they've been in a long, long time. You can go check out this article and read that. And I'm not saying there aren't going to be people that aren't affected by a slowdown in the economy. There very much will be. But homeowners that are, one, have options today. They can sell their home, pay a commission, put a little bit of money in their pocket, and move to the other side of the financial crisis they're facing. And I think that's important. If we even look at this and think about foreclosures are up this year, but they're near record lows. As of the third quarter, there have been 88,000 foreclosures in this country. If you play that out, that would mean we'd have between 120 to 125 foreclosures as we wrap up the end of the year. To put that number into perspective, in 2019, there was 278,000 foreclosures in this country. Nowhere near what we were heading into the pandemic. Critically important. We always say that headlines do more to terrify than to clarify what's actually going on. And relative to consumer debt, to mortgage debt, to really things that are happening out there in the world, our job is to be the knowledge broker, to be the most knowledgeable professional on these topics for the clients we serve so that we can help them make a wise and confident decision. Now, what I'm going to do is I'm going to turn it over to Kate here to talk about the 2023 housing market forecast. No doubt there are going to be questions that come up over the next market on what's real estate going to hold next year, and this is the answer.
Thank you so much, David. I think as we start to talk about the housing market forecast for 2023, the best place to start is where have we been so far this year in 2022? And I truly think that this housing market has been defined by two key things: inflation and rapidly rising mortgage rates. Now, we're starting to see signs of inflation easing, and we know that the Federal Reserve is still making moves to lower inflation, and we're certainly not out of the woods yet. But where that lands is really going to impact what happens with the housing market next year. And I think the housing market in 2023 is going to be defined by, can the Fed bring inflation down and keep it there? And will we see stability in the market, especially around mortgage rates? So where I want to begin today is talking about mortgage rates, home sales prices, how all of these factors are starting to come together for 2023 and what the experts are saying. And I think we can actually begin with a quote that we shared with you earlier this year, in about June of this year, from Jerome Powell, the chair of the Federal Reserve. And I think this really sets the stage for what the Fed was out to do this year. So it says, I'd say if you are a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together and where inflation is down low again and mortgage rates are low again. So in June, this is exactly what the Fed was saying. We need a bit of a reset. We need to slow the economy. We need to get the housing market back into a place where it's a little bit more balanced. So, all of that is driven by inflation. So we've watched the Federal Reserve make moves to try to lower inflation this year. That work is still in progress, and we are certainly not out of the woods yet. But it's definitely had an impact on mortgage rates, on buyer activity, on inventory, on prices. It's really put the market back into that reset position. And there's much more to come in that space. So if that's really what started to define 2022, let's talk about where 2023 is headed and what the experts are saying. So I want to begin with mortgage rates. And I think we can all agree, just as I just mentioned, 2022 defined by rising mortgage rates. And this is a look at the Freddie Mac 30-year fix going all the way back to January of this year. If you follow along with us, you've definitely seen this before. And the big takeaway is that rapid rise. This has never happened before in a calendar year. Mortgage rates more than doubled this year. And we've never seen that before. And so it's less about the number. It's less about the fact that, a little over a month ago that mortgage rates ticked up over 7%. It's really more about that rapid rise that has caused uncertainty, confusion, people in the market just saying, hey, I'm not ready to jump in. And that has had an impact on the balance of the housing market. It has slowed buyer demand. It has slowed the pace of sales. And that's really what we've been looking at this year. So as we start to think about what's ahead for next year, mortgage rates are really hard to project. It's all about inflation. We're going to continue to watch inflation. And as inflation is high, mortgage rates tend to be high. But as we're starting to see signs of that potentially turning, we want to know where mortgage rates are going to go. And so what the experts are saying right now, if you look at Freddie, Fannie, MBA, and NARM, we average those together roughly somewhere between 6 and 6.5% next year. So starting out about where we are right now, possibly ticking down if inflation starts to come down too. And, the reality of it is it's less about the number. I said that a moment ago. And it's more about the market is looking for stability, looking for mortgage rates to kind of level out. Now, whether that's somewhere between 5.5 or 6.5%, the goal is for mortgage rates to stabilize. And we certainly aren't talking about the record lows that we saw over the past 2 years, but we shouldn't be talking about rapid acceleration either. So as inflation starts to turn, that's what we are going to be looking for to see what happens with mortgage rates. And this is, realistically what experts are saying right now. And I think this quote from Greg McBride at Bankrate really says it well. It says mortgage rates could pull back meaningfully next year if inflation pressures ease. It's all about inflation. That's what we've been talking about this year. We're going to continue talking about it next year. The Federal Reserve is meeting again later this month. And if they continue to hike federal funds rates up as aggressively as they have been, that's going to have a different impact on mortgage rates. So the reality of it is they may go up before they come back down. It's really not a matter of if mortgage rates will come back down. It's really more of when. And that's what we're going to be watching in response to inflation. Now, as we've seen inflation rise this year and as we've seen mortgage rates tick up, that's impacted home sales. So let's talk about what home sales look like so far this year, and let's talk about the projections for next year. So total home sales for this year, you can see that green bar right there. This is a combination of existing homes and new construction, projected to end the year around 5.8 million home sales. Now, coming off of last year, that feels like a major slowdown. We sold roughly 6.9 million homes last year. That was significantly higher than where we are right now. And if you look back in time, that's what you can see on this graph. This goes all the way back to 1999. We haven't seen 5.8 million home sales in about 10 years or so. So this is going to feel like a slowdown. You're probably already feeling some of that right now. And if you've been in the business for the last 5 to 10 years, you haven't seen a year like this recently. And so, we use that analogy all the time of last year felt like you were flying down the highway at 90 miles an hour. Things were moving really fast and you came around the bend and saw all those flashing lights and you kind of hit the brakes real hard. And while you were still moving forward, it felt a lot slower. So coming off that high of 2020 and 2021, this year feels a little bit slower. And if this feels slow, let me share with you what next year is projected to look like. 5.1 million home sales. Now, that's going to feel even slower. However, I want to park here for a second, talk about this projection for next year that the experts are saying. Now, 5.1 million home sales, less than this year, definitely less than last year. But here's the thing, experts tend to reproject throughout the year. And right now they're making projections for next year. And it's based on a lot of different things. And right now we're in a place where inflation is high, mortgage rates are high. We're still seeing buyer demand, but it's not as high as it was. We have more inventory on the market, but we're not seeing a ton of new listings. We're seeing new construction slowing a bit. And so projections for next year are clearly lower. Now, I think as we start to see that nod towards the Fed getting inflation under control, mortgage rates potentially coming down in that moment in time, as we start to see that, I anticipate that this number, this 5.1 million home sales, will start to tick up throughout next year. It's really not a matter of if, it's more about when we start to see that activity really kick back in. So we're going to be continuing to watch this forecast as we go forward and continue to bring you that information on how are experts reprojecting throughout the year, because we do see that quite a bit. And if we look ahead at how some of the experts are breaking down total home sales for next year in millions, anywhere from about 4.5 to 5.5 million homes. We like to put that into context to average them all together and to really look at this and say, the truth is probably somewhere in the middle, maybe not the high end, maybe not the low end, but the average right now is showing about 5.1. And we're going to continue to watch that number. And so, the question becomes what's going to tick back up? What's going to cause more transactions? What's going to kind of reinvigorate that number next year? And I think this quote from Lawrence Yun really says that well. It says, The upcoming months should see a return of buyers as mortgage rates appear to have already peaked and have been coming down since mid-November. So as we start to see inflation hopefully come under control, mortgage rates respond, we are going to see more buyer activity. Buyers are looking for stability and predictability in the market. And as that starts to unfold, we've got a bumpy road ahead. Hear me out on that. As that starts to unfold, we will see more buyers come back to the market, and that should start to increase the pace of sales as well. And, it says that mortgage rates have already potentially peaked. We hope that that is right. We are going to continue to watch that because that's a really big part of the cascade that we've seen happening in the market this year. Now, as we start to talk about, next year, home prices are the big thing on everybody's mind as well. And I want to walk through what the experts are saying about home price forecasts for 2023. And I think this graph really kind of breaks down several of those leading experts. And really, the latest forecasts we have are showing that some experts are saying home prices to appreciate a little bit next year. Some experts are saying home prices to come down a little bit next year. This is year over year appreciation for 2023. Now, again, context is key. We bring all of these together, we average them all out. And if you look across the board, roughly neutral or flat home price appreciation next year. That's what happens when we kind of pull all these together and take a look at the grander picture. The clarity and the truth is probably somewhere in the middle. So that's where the average really comes from. And we're coming off a point in time earlier this year where we had 20% year over year home price appreciation. We're certainly not looking at that going forward, but we're also not looking at massive declines. No one is calling for, 10, 20% home price depreciation. So this is all about supply and demand. The more buyers we have in the market, the more home prices will rise. That balance of more buyers than homes available, that tends to put upward pressure on home prices. And right now we're sitting at about 10 to 11% year over year home price appreciation. Now we've also been looking at month over month home prices. And as we've seen a little bit of month over month declines, here's what we're also seeing right now is that decline is getting a little bit smaller. So as we look into next year, we're really looking at flat or neutral home price appreciation. It's going to be different market by market. We have some markets, especially out on the West Coast, that were much more overheated, and they're going to see more movement in home prices than some other markets. But we're going to continue to bring, what's happening with supply, demand, all of the things that impact home prices for 2023. And I think this quote from Mark Fleming really kind of talks about the demand that we're looking for. And it says, the housing market, once adjusted to the new normal of higher mortgage rates, will benefit from continued strong demographic-driven demand relative to an overall long-run shortage of supply. We still have more buyers than sellers in most markets. We still have this massive demand from millennials aging into the home buying age. And, all of those factors are going to continue to put upward pressure on home prices. And again, this really nods toward looking for that stability. Once the housing market has adjusted to the new normal, adjusted to mortgage rates potentially settling into a more stable range, we're going to see more buyers come back into the market. And that's going to really tip, what we're feeling right now for 2023. And I want to end on this quote from Doug Duncan from Fannie Mae, because I think this really says it well. It says, from our perspective, the good news is that demographics remain favorable for housing. So, that demand that we see, still a demand for people to buy homes. So the sector appears well positioned to help lead the economy out of what we expect will be a brief recession. So I started at the beginning talking about how this is all about inflation. The more we start to hear inflation coming under control, inflation coming down, that sparks that conversation about a potential recession. As we talk about a recession, we never want to wish a recession upon anyone, but more and more likely that we will see that if inflation starts to come down. And the question becomes, what does that mean for the housing market if we do see a brief recession? History tells us mortgage rates come down. what happens as inflation lowers and mortgage rates come down. We will see more buyers come back into the market. Definitely buyers have more options to choose from now. They're looking for stability. As we start to see all of that unfold, we're going to see 2023 respond in that way. So, what's the overall takeaway? It's all about inflation. The market is looking for stability in 2023. We're looking for mortgage rates to kind of stabilize and become more predictable. We're watching the economic drivers around us, and we're still seeing demographic demand that is going to drive the housing market forward. So, as we wrap up, I want to remind you that we now have our winter buyer and seller guides available. These are great resources for bringing to open houses, to sending to your clients digitally. So, they have everything that they need with the most hyper relevant information so they can make powerful and confident decisions when it comes to buying and selling a home. And that certainly makes you the expert if you can put these guides in their hands. So you can head over to the member area, downloads, they're personalized for you. Really, really great resources that I encourage you to use as you go into 2023. And of course, we will see you back here